In this video, guys, I'm going to take you through the essentials to ICT market structure. Now, if you want this PDF, this free PDF, check out the link in the description of this video. I'm going to post that in there for free. Now, with that being said, I want to get into the video. Again, a lot of people talk about ICT market structure, and you've probably, come here because you already understand the basic principles. You understand the trending market, you understand the range-bound market, but you're looking for more, right? So today, my goal is to give you a little bit more with a few examples. And firstly, I want to touch on the topic of what can actually indicate a reversal in price action. What's it look like structurally in the market? So a lot of people ask me, they're curious, they say, hey, Ruben, what market structure will indicate a reversal? Now, we've all heard of the sweep of liquidity, a market structure shift, a return to a fair value gap, but I want to explore a few options here, and I want to take a deep dive into what you're seeing in price action. So looking at this is just simply an illustration, nothing more, nothing less. We've got one swing low, another swing low, and a third swing low. And we'll talk more about these different forms of swing lows and how they're all important in just a minute. So in this illustration, there are a few things that I want to point out. Firstly, the market has swept liquidity, right? So from point 1 to point 2, we've had a sweep of sell-side liquidity. This is the basis of any kind of reversal, sweeping sell-side or buy-side liquidity. Then the market has created a higher swing low, and in doing so now creates an inversion fair value gap, change in the state delivery, and market structure shift. Let's dive into that a little bit further. So we've swept sell side here, and we'll look in the charts in just a sec. We've swept sell side here, we've formed a high swing low. Now in doing that high swing low, we've come up here from point 2 up here, and we've inverted a fair value gap in this price swing. We've also created a change in the state. Now the fact that this swing low, point number 3, is higher than point number 2, this makes point number 3 a failure swing, right? So that's what I've got outlined here. I've got this is the initial low, this is the protected low, and this is the failure swing. You might be saying to me at this point, well, why is the failure swing important? A failure swing essentially just indicates higher price action, right? So if we've been trending down, obviously we're going to form lower lows. If we've been trending up, we're going to form higher lows. But there's more in-depth information that you can get out of this price swing, which we're going to look at in just a moment. So the high swing low paired with, say, for example, a market structure shift or a change in the state, that indicates a failure swing. Keep in mind, just because we put in a high swing low does not make it an important failure swing. Doesn't mean it's important. We need to have a shift in structure. We need to have an inversion. We need to have a change in the state delivery. We need to have these things paired with a failure swing. So the failure swing is the basis of the change in market structure from bearish to bullish. Pairing this with a market structure shift, an inversion, and a change in the state, this actually signifies this and crystallizes this as a proper and important, or confirms it, if you like, confirms it as a failure swing. Now, what I want to do, I want to keep the ball rolling and look at another example. Now, when a failure swing is formed, this is an indication that the previous low should be protected. So for example, we sweep sell side here, we form a failure swing, we push higher, we have a shift in structure. This swing low here at the bottom, that should be protected, right? So it's called sometimes a protected low or protected high. And this is where you hear ICT talking about, short-term lows, short-term highs, but I'm trying to explain it here in a simple way because this is pretty much what he's talking about. So all this means is that the protected low should not be swept. It does not apply to the failure swing. The failure swing, this one here, can be swept. And I want you guys to have a look at this example here. We've got swing low 1, swing low 2, swing low 3. Now, swing low 2 should not be swept once we form a high swing low and once we push up, creating a shift in structure. However, swing low 3 can be used as a liquidity pool to induce traders to go short to then push price higher. So when price comes up, we haven't taken out this swing high. We've got one high and two highs, relative equal highs. When price pulls back, we can sweep swing low 3. However, once we sweep swing low 3, we're looking for price to immediately reverse or immediately react back to the upside. Now, I want you guys to have a look at this example here, straight into the charts, right? Have a bit of a look. We've got, macros, we've got heaps of things we can talk about and we can take a deeper dive. Now, what I want you guys to look at is we've got our sell side sweep. So looking back to the illustration here, point number 1 or sell side point number 1 is this swing low. Point number 2, which you talked about before, is now this swing low. And point number 3, which is the failure swing, is this swing low here. Now, I want to take you through step by step all the opportunities that you could take using market structure and how I'd personally read the price action. Now, once we have a sell side sweep, here's the thing. Just by sweeping liquidity does not mean we have to retrace or reverse, but it can be an indication of a reversal. How do you get an inkling as to if it's going to or not? Number one, you're looking for price to be in a macro because macros can reverse. And you can see here at the bottom, that's 3 o'clock. So in the middle of the macro, price can reverse. Number two, you're looking for price to be in a silver bullet session, which are in the silver bullet session here too. Or number three, you're looking for price to sweep internal sell side here and deliver from a higher time frame fair value gap, for example, on the 15-minute. All those three things could indicate a reversal, and this is what we're seeing here. So we've got a sell side sweep, and flag number one, which I've marked out here, our entry for flag number one could come from the inversion fair value gap right here. Once we invert that fair value gap in orange, our stop goes below the bodies, not the wicks, the bodies is sufficient, and we can take price to buy side level number one, right? The failure swing forms here. These set of down close candles, when we break above that, that creates an order block. We trade back into that and price pushes higher. Now, here's the thing that I tell a lot of people. Can you enter from this first point here, the bottom swing? Yes. Can you enter from the failure swing? Yes. But it's better to enter from the lowest point rather than the higher point. In this situation, notice how the buy side level one, these two relative equal highs, that is your low hanging fruit. So if you're going to take a trade from here, for example, from the second point, the failure swing, there's not really that much room for price to move. Yes, price could go all the way to buy side two without retracing, but it doesn't always happen that way. So what I like to tell people is, if you're going to enter when the price has already moved in the direction, reduce your risk, but also consider, is the risk to reward worth the trade? Is it worth it, right? Because for example here, we create the order block, we trade back into it. For me, buy side level one is where I want to take partials and where I want to go to break even. So assume someone entered from down here, partial comes off here, break even. If I want to hold a runner, I'll be holding to this buy side level two, which is an original accumulation and relative equal highs. Now, flag number three is where we sweep the failure swing. What you're looking for in terms of market structure, if we are still bullish, we can sweep this failure swing. However, once we sweep it, we should immediately react from the sweep. Similar to what we've done here. We've swept sell side, we react. We form a failure swing, we come back down, we sweep sell side, we have to react. If price closes down here, what do you think is going to happen? It's probably going to go to this low. Now, I want to point out this, failure swing and how we sweep that. If price were to close down here, the only reason why we wouldn't sweep this low, the only reason, well, there's two really. Number one, we could be respecting optimal trade entry from this low to this high. Or number two, we could actually form SMT. But until those things form, until there's a reaction from that point, the market structure, if we close down here, for me, would look bearish. So what you want to see with this failure swing, and you'll see this in a bearish and bullish example, you want to see an immediate reaction if we're going to use that to get more liquidity, to get more energy. See this, right? See this sweep as price generating energy. It's grabbing that liquidity, it's grabbing that pull, it's grabbing that energy, it's grabbing that power to then continue up in the desired direction, which ends up being these relative equal highs. You can see how quick the price moves there, and that's buy side level two. Again, this is exactly what I'm talking about. And an important point really to mention is that you don't have to take trades at each point. You don't have to take a trade here. You don't have to take a trade. You don't have to take a trade here, but they offer unique opportunities based on the style of trader that you are. So for example, you might like to use inversions. You might like to use market structure shifts. You might like to wait for further confirmation. So maybe you're waiting for this third point. Maybe this is a bit too early. You're too nervous to enter this. You'll wait for more confirmation, then you'll enter the trade. So this is really important, guys. You don't have to enter from every single position. I want to point that out. I really want to point that out. You can simply choose what you prefer, and you can weigh up the risk to reward and other factors. And these are things we're going to discuss. Again, this is a really good example. I've got all this annotated here. So if you want to have a look, dive into this free Discord. The PDF will be available there for you guys too, right? What I want to talk about now is the opposing side of things, where what indicates to me where price action might be going bearish, right? So we have the same example. We've got point number 1, 2, and 3. That's your failure swing. But what for me would indicate, okay, wait a second, price may want to actually go lower now. I'm probably offside with the market. I should get out or shouldn't enter the trade again. This is what we're looking like in terms of the framework. Now notice here we've got the failure swing. We come down, we sweep it, but we close aggressively below. That's not a good sign. If we're running extremely aggressively down, it's not a good sign. If we pull back and then close back below here, what do I expect? I expect that original low, which is now no longer protected, to be swept. The chances are if we sweep the failure swing, we're below OTE and there's no immediate reaction, based on chance, based on probability, we're probably going to take out the swing low. These are, guys, if we sweep that failure swing, if we sweep it with some displacement, if we've, push down with some big down close candles, and then we start moving lower like this, and we've disrespected OT, and there's no, SMT, the chances are we're going to go to this low. It's all about probabilities. And again, I say probably because it's all a chance and a probability game. So let's take a look at this example. Now we've got the sell side sweep here. So this is swing low number 1, this is swing low number 2. All these numbers represent just all the swing lows that are formed, or all the important parts that are formed after the initial sell side sweep. So again, as we talked about, you can enter a long position at point number 1 here once we invert this fair value gap, right? If we're delivering from a higher time frame gap, we sweep liquidity, that might be your model targeting these low resistance highs. That's opportunity 1. Swing low 2 and swing low 3, here's the thing. Both of those swing lows, what are they doing? They're respecting these bullish fair value gaps. That offers opportunities to then enter the position long to take it higher. As you move higher up in the move here, here's the thing. We're forming higher swing lows. That's your original failure swing. That's another failure swing. But again, these can be swept. You're just making sure that if these are swept and you're still in trade, you're demanding the price immediately react after sweeping one of these, or both. So for example here, we come up, we tap into this CB, we pull back down, we sweep this failure swing, but what do? We immediately react back to the upside. That is another opportunity to go long from this inversion targeting this swing high. Now eventually look what happens here. 9:30 open, we push price, past these swing highs. But look what price does, look at market structure. So we've got these high swing lows, we pull back against the failure swing, we have that reaction, beautiful. We're expecting that this swing low now, swing low 4, we're expecting that if a high swing low forms, swing low 4 should be protected, right? So we've just swept liquidity, we've formed a swing low, we swept liquidity, formed swing low, we push higher. Now, what does this look like here at 0.5? Look at how aggressive price is moving down here. Look at how aggressive it is. This massive down close candle right here. Does it really seem like with this closure of this candle that price wants to reverse from here? It doesn't, right? Candle number 5 kind of signifies it. What's that indicate to me? Right? Nice big body close, 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 close. That indicates that price more than likely is going to move to this swing low, the original swing low. Right? But how price trades leading into the swing lows that are formed on the price swing also means something important. So this is the basic structure, or this is basic market structure, how I read the market and what I look for if I'm in a trade. If I'm in a trade, I'm looking for price to respect these zones. If I'm looking for a trade, then ideally what I like to take personally, I like the original entry, or if there's still a clear draw, I don't mind this second entry here because we're still sweeping sell side. And if I can pair that with silver bullet, if I can pair that with a macro, then I know I'm in a high probability setup. I know I'm in a high chance setup because time is important and price is also important. So keep that in mind. So again, guys, it's up to you how you enter these trades. These are just examples of how you can read the market, what you're expecting, talking about, intermediate term lows, short term lows, but in a simple, in a simple way. It doesn't have to be complicated. Yes, we know if price is making high swing lows, it's important, but what about if it doesn't? When do you draw the line? When do I draw the line? And as I mentioned before, guys, for me, I like taking setups from this initial sweep or from this secondary sweep. Once we have price move back down again, I'm really no longer interested because we've now swept liquidity a couple times. I'd rather price in this case move to these highs. If it doesn't, I'd assume we want to go lower first, and then I'll be looking for a setup after that. Again, guys, if you like this video, let me know. If you want the free PDF, it's going to be in the link of this video. And until next time, guys, I'll talk to you then.